My name is David and welcome to David Computes. In a previous video I've showed how to calculate market gaps using Excel, and I showed some simple calculations. I used the Standard & Poor's daily data to show some of the things you could do. And I was thinking on that basis, I thought to show you a few more things I thought were interesting, and this is what I've prepared here. I have the same data set as I used before. This is daily data from the Standard & Poor's 500 all the way from 2004 to the end of July 2021. So I have the usual columns with open, high, the low and the close. And I've calculated a few data. So I've calculated the percentage for the full session. So for the full session means I've calculated from the open up of the previous day to the open of the current day. And then I've done another column G where I've basically accrued, I've transported the gain of each day and I summed that up all the way. And then I've done a similar thing just for reference, which was just buying the open on that and then closing the very last day of the time series, just for reference with a full session. So when I call it full session, just to clarify, it's actual, it means the cash session and the overnight, so the futures traded, so basically almost a 24-hour cycle. Then I've calculated the gap, which is basically just the difference between the close of the previous day, as you can see here in the formula, and the current day. So that difference there is what I've called a gap. This is the same way I've calculated last time. And then the same, I calculated another column, which is the accrued gap, which I just transport the previous gap and I added up all the way. Then I've calculated the gain for this only for the cash session. So from the to the closure of the cash session, so the Standard & Poor's 500. So that does not cater to the futures trading or overnight, whatever you want to call it. And again, on column L, I've just added and aggregated and transported the value. And lastly, I wanted to have a column showing the difference between if you had the position using the full session, so the overnight and the cash session, and just the cash session, and I show that value there. And again, I've did a few statistics here for this percentage of the full session minus cash session, but without accruing, just each day's difference. And I've calculated a few statistics here to have a feel for it. So our usual statistics that I generally show how to calculate on the spreadsheet. The counts, so basically gives the number of rows for our data series, the number of days, in this case the number of days that were traded, the number of days which were positive, the same data but then in percentage, then the average, the median, the max and the minimum, nothing important, just the basics. So having done these few calculations, I'm going very quickly over each one of them. If you do have any questions or if you have any comments to do, please feel free. So I'm happy to revisit those, especially if I find the questions valid and important. Anyway, having calculated that, I decided to graph these results into a simple graphic in Excel, which is something I haven't done in the past, but perhaps I should cover more often in my videos, how sometimes just doing a simple graph can help you visualize the data you're having and makes it easier for you to interpret and build an analysis on whatever study you're doing. So this, I've done the same here. This is a simple graph, a line graph, and I've plotted 3 times time series. One is in light blue, the full session, so the aggregated value of the full session, and then the same one just using the cash session, so just the Standard & Poor's 500, and then just the gap. And I would like to show that there's a lot to impact from this chart. So one of the things you can see is that, well, the gaps actually all the way to 2008-ish or beginning of 2008, there's not many of them, and if you add them, there's generally stays around the zero. So you have a gap up one day, the gap down another day, but overall they tend to counter each other, and it brings you back to zero if you sum them. And the consequence of that, if you want to call it consequence, is that the accrued for the full session and accrued for the gap for the cash on session, which you can see in light gray, more or less overlaps, meaning they're more or less the same. There's little variations from day to day, but because the gaps on the upside and the downside are more or less the same, they tend to sort of counter each other, and they nullify each other. But then what happens is at the beginning of 2008, what you can see is that the full session actually starts to diverge from the cash session only, and you can see that by light blue making lower lows, and you can see that on checking on just the gap only, and you can see how the gap only starts actually, you have going down, which implies that you start have more gap downs than gap ups, and as you aggregate from day to day, it goes into the negatives, and again, what that shows after the low from 2009 financial crisis from the March 2009 is that the cash session always has a spread, a positive gap compared to the full session, and you can see that all the way it keeps going pretty much all the way to mid 2013 more or less, and you can see that different more or less stays the same, and you can see that the gaps only stays more or less flat, meaning again that you see the same behavior you saw until the beginning of 2008, which is the gaps ups and the gaps down tend to be equivalent, and overall they counter each other. But then again, what happens is on 2013, you see the slope here starts having a gentle slope. It gets even more pronounced by end of 2016, and you see a very pronounced slope. It gets with a very big positive. This big dip here you can see is of course from the beginning of the pandemics in March 2020. But what you can see here is that notice how the difference between the cash session and the full session starts to diminish, and by the beginning of 2017, by May 2017 roughly, you see that the full session overtakes the cash session, and the change seems to be increasing more and more. And you can see that on the cash side. So basically the conclusion, I'm trying not to make it a too labored conclusion here, but you can see how the gaps tend to be more and more more often positive, and perhaps even bigger. We can't take a conclusion on that, but you can see as a crude, you can see how the gaps tend to be on the upside. So what it means is on a regular basis, there seems to be always a gap up. So the market closes the next day, opens with a gap up, and off he goes. And it means that if you fully invested on the full session, you can see how that gains goes to your benefit. The only exception is briefly here. You can see that during the correction during the beginning of the COVID epidemic, you can see how the gaps have a big dip here, and the full session actually in value gets very close to the session only value, which means that during this correction, the gaps were strongly negative on the overnight session, on the future session, and then there seemed not to be such correction during the cash only, so the cash seemed to hold price, and they rinse and repeat for that February, March, April. And then we resume again the same behavior, and look at the difference in between having the full session and the cash session only. So that's a very interesting conclusion to take, and how the market has a very different behavior from usual behavior where the gap ups and gap downs are more or less balanced. And if you were to plot data before 2004, you find a similar conclusion. Again, this can only be done for Standard & Poor's 500, but I would actually invite you to do that for another index or a stock or another financial instrument, an FX pair or commodity, and see what you get there. That would be quite interesting. But let me show you just two more graphs quickly before I finish this video. So on graph 2, I just put the difference between the cash session and the full session. So basically the difference between the light blue and the light gray. And this is what you have. And it just shows much better what I was trying to describe on the minutes before on this video. You see how until beginning of 2008, just generally, you can see the variations here. There's the difference between one session and the cash session and full session. It tends to go up and down, but overall tends to be in this line. Then there's the big dip during the financial crisis, and then it stays flat more or less like it was before. And then as in mid 2013 more or less, you start to see the prevalence of positive gaps, or the gapping up, with exception for the COVID correction. But you can see here, and there's quite a steep incline, so quite a positive bias here. This visualize, and this is very simple charts to produce with Excel. If there's requests for it, I'm happy to perhaps do a quick video on how to do these charts if you find this complex and you think you'd benefit on how to chart an Excel. And the last chart I want to show you is just basically just the difference. So without aggregating, just the difference from session to session, a full session minus the cache session. So you can just see, obviously always the baseline 0, and that's the red line, and I call it just baseline. And then I did a 22 moving average, which is more or less the equivalent for 22 working days. So more or less a month rolling moving average of that gap. And you can see you should expect this overall to always be moving around 0. And I was expecting to see a more pronounced idea this on mid 2013, when that gap to the positive side started to be more visible, and again increase again in 2017. I mean, you can see it a bit, but it doesn't really show you much, but it's still a valid chart. But if you go back to the usual to the data, you can calculate. You can see here on my calculations on average and mediums that is actually positives, although it is for the full set. If you were only to look at the averages and mediums for the data from 2013 onwards, and again just with data from 2017 onwards, you see this a much more pronounced value, which was what I was hoping to show this, but perhaps the scale is not the best to show that. Anyway, this is just a quick analysis on the gaps, and I think you can agree with me that there's a lot of value to be taken from study gaps, and how simple it is to do this on Excel, and how much value you can take from this. Anyway, I'll leave you with this. I hope you found this useful and inspiring. I hope you enjoyed it. If that's the case, please leave a like and subscribe. I'll be leaving some reference as well to the video that I mentioned in the beginning with a market data study on gaps using Excel. Thank you very much.